Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Apple.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you trade stocks, crypto, forex, gold, or indices and want clearer buy and sell signals, you can check out VIP indicators through my link below. Grow $100 to $10 Ks with VIP Indicators. VIP Indicators offers TradingView indicators, market alerts, trading education, and chart reading support with up to a 93% win rate. The tools are designed to help traders spot possible setups faster and trade with more confidence. But please remember, trading is risky. No indicator can guarantee profits, and growing $100 into $10 K is not guaranteed. Use these tools for education and analysis only, manage your risk carefully, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
All right, let's move into the wealth building context. Because if you still think this company is just, a phone manufacturer, you are completely missing the biggest wealth transition of the decade.
Oh, absolutely. I mean, for years, the whole thesis for holding the stock was tied almost entirely to that boom and bust hardware cycle. It was a very predictable rhythm, really.
Right. You bought the stock basically hoping the next physical design was a massive hit.
Yeah.
And, well, if it wasn't, you just had to grit your teeth and wait it out.
Yeah, you really had to weather the storm for a year or two. But looking at the structural shifts happening right now in 2026, I mean, that old thesis is totally dead.
Completely dead.
Yeah, we are looking at an evolution into an AI-powered, incredibly high-margin, recurring utility.
Exactly. And, if you're sitting there building a portfolio for the next 10 years, you really have to understand where this massive capital allocation is flowing. They aren't just selling you a nice piece of glass and metal anymore.
No, not at all. They are selling you the ecosystem. They're selling the privacy, and increasingly this artificial intelligence layer that just manages your entire digital life. It's really what we call the super cycle.
Yeah, the super cycle. Now let's look at the fundamentals. Because narratives are fun, sure, but we need to see the actual proof before buying into any of this hype.
Well, the numbers they just dropped for the fiscal second quarter of 2026 are honestly staggering. We are talking about total revenue hitting $111.2 billion.
Wow. Just to pause on that, $111.2 billion, that is a 16.6% year-over-year increase, right?
It is. And for a company of this gargantuan size to grow its revenue by nearly 17%, I mean, that's like turning a massive battleship as quickly as a jet ski.
Yeah, it really is. And that marks their fastest growth rate for any quarter since, 2021?
Exactly, which completely validates this idea that their transition strategy is working right now, today. And when we break down that $111.2 billion, we start to see the real mechanics of the transition. Yes, the hardware cycle drove a solid 22% surge in phone revenue, pushing that segment up to $57 billion.
But that's not even the most important number in the report, is it?
No, it's really not. The real anchor here, the piece that structurally reduces the risk profile of the whole company, is the services segment. It reached an all-time high of $31 billion, growing at 16%.
Let's make this tangible for the listener, because services are the key to everything here. Think of it like this. Having 2.5 billion active devices globally, it isn't just a vanity metric. It's essentially the ultimate top of the funnel.
Right. It's like buying the admission ticket to a theme park.
Yes, exactly. The company makes money at the gate when you buy the phone, absolutely. But the real wealth generation, that continuous cash flow, happens once you are inside the park.
Yeah, when you start buying the $10 express passes.
Exactly. Paying for extra cloud storage because your photos are full, the music subscriptions, the App Store cuts, and now all these premium AI features.
The theme park analogy is so perfect, especially when you look at the margins. Because while it costs billions to physically build the theme park, the hardware, the chips, the supply chain, charging you a monthly fee for that digital express pass costs them almost nothing to maintain.
Right, the overhead is basically zero at scale.
Exactly. Services boast an estimated 76.5% gross margin. Compare that to the physical hardware side, which sits at about 38.7%.
So just to be clear, every single dollar they make in services is essentially twice as profitable as a dollar made selling a physical phone.
Yes, and as the overall revenue mix shifts heavier and heavier toward those services, it structurally lifts the entire corporate margin profile. It literally changes the DNA of the company.
This is why we saw their diluted earnings per share, or EPS, climb 22% to $2.01. Their profits are growing significantly faster than their overall revenue simply because the things they are selling now are way more profitable.
Which generates just an absolute ocean of cash. And that brings us to a massive strategic pivot. They are sitting on a fortress of a balance sheet right now, about $68.5 billion in cash and marketable securities.
And what really caught my eye here is what the CFO recently announced. He officially signaled they are dropping their historical net cash neutral target.
This is huge. It's a monumental shift in corporate behavior that I think, well, a lot of people might just gloss over as a accounting jargon.
Let's translate this then. For years, this incredibly conservative management team had a goal to hold roughly the same amount of cash on hand as they held in debt, right? That was net cash neutral.
Right.
But now suddenly they're saying, we don't need to keep our cash and debt perfectly balanced anymore. They are evaluating them totally independently. On top of that, they just authorized a staggering $100 billion share repurchase program.
And raise the dividend to 27 cents per share. So when a company drops a conservative cash target and simultaneously authorizes a $100 billion buyback, they are screaming to the market that they view their own stock as severely undervalued.
And just to clarify how a buyback works mechanically, if the company is a pizza, and there are millions of slices out there, the company is using its massive pile of cash to buy back those slices and just, well, destroy them.
Yeah.
So the slice you currently hold in your portfolio suddenly represents a slightly larger percentage of the whole pie. It makes your shares more valuable without you doing a single thing.
Exactly. And at $100 billion, they are providing an institutional level floor beneath the stock price. It guarantees this sustained, relentless buying pressure from the company itself.
That brings us to the catalyst timeline. Because with an aggressive new stance on capital and this massive war chest, what exactly are they building next? We're seeing a 34% surge in R&D spending.
Right, a massive capital outlay. And the answer to where all that money is going is the on-device AI paradigm.
This is where we need to clearly separate what they're doing from what, the rest of the tech industry is doing. Right now, for most cloud-first competitors, when you ask an AI a complex question, your device doesn't actually do the thinking.
No, it just fires your prompt over the internet to a massive, power-hungry server farm somewhere. The servers do the math and then send the answer back to your screen.
Which means your data, your personal questions, your emails, everything has to physically leave your device.
Precisely. And that is a massive vulnerability. So they're spending that huge R&D budget to build a privacy-preserving moat via their custom silicon, specifically those A19 and M5 chips.
Wow, okay.
Yeah, they are designing chips so powerful that the artificial intelligence can run locally, entirely on your phone or laptop. No server farm required at all. Your data literally never leaves your device.
That is a massive, tangible selling point.
Yeah.
For the modern consumer, privacy isn't just a buzzword. It's a core product feature. I actually saw a note that the AI startup Perplexity just chose the Mac platform for building enterprise AI agents. So the industry is absolutely recognizing the power of this local computing.
Oh, definitely. And the timeline for this narrative is moving fast. The single most critical near-term catalyst is the big developer conference on June 8th. We are anticipating the rollout of their foundational AI platform alongside personalized AI upgrades.
It's crazy to think about what a native digital assistant could be if it actually had real, contextual AI powering it directly on the hardware.
Right. And speaking of catalysts, analyst Dan Ives recently set a $400 price target for the stock. He dubbed them the consumer hub of AI. But the craziest number is that he's predicting $15 billion in incremental AI-driven services revenue.
Wait, $15 billion?
Yeah, $15 billion. That is not just a neat little feature. That is an entirely new, massive business segment being born right before our eyes.
That is staggering. And let's not forget the supply chain catalysts hidden here, too. There are serious rumors circulating about an Intel Foundry deal.
Right, and that sounds incredibly dry, but the geopolitical implications are huge. Currently, they rely almost entirely on TSMC in Taiwan to physically print these advanced chips.
And having your entire central nervous system manufactured on an island in one of the most geopolitically tense regions on Earth is, well, it's a massive single point of failure.
Exactly. So if they reach a preliminary agreement for Intel to manufacture silicon in the United States, that is a massive strategic move. It diversifies them away from Taiwan and really insulates their supply chain.
Plus, the persistent product rumors of a foldable phone form factor coming this fall. That could drive yet another massive hardware upgrade cycle. Now let's pivot to the chart. Because we know the fundamentals are a fortress, but how is the market reacting technically?
The technical momentum is pretty undeniable right now. The stock recently cleared several key resistance levels, breaking through ceilings at $280, then $285, and most recently pushing past $294.
Yeah, it's currently trading around $293.84, which is up 13.2% over just the past month.
Right, which implies a complete breakout from its prior consolidation ranges. The market is aggressively pricing in this structural AI inflection point.
So what does market sentiment look like?
Well, the news flow is acting as a major tailwind. Greater China revenue rebounded strongly, up 28% year over year.
Oh, wow. That completely crushes the prevailing narrative from last year that they were losing their grip on the Chinese consumer to local competitors.
Exactly. Furthermore, we are seeing institutional upgrades from Bank of America and Goldman Sachs, citing the sustained hardware strength and this upcoming AI upside.
Yeah, which gives us an 8 out of 10 bullish score in our research. But here is where it gets really interesting for me. Now let's talk about the risks, because I have to push back a little bit here.
Sure.
When sentiment reaches this absolute fever pitch, when everyone on the street unanimously agrees a stock is an unstoppable winner, I get a little nervous.
Yeah.
Is this euphoria blinding the market to reality? Because no company operates in a vacuum.
That is exactly the kind of critical thinking we need. A technical breakout is great, but there are very real threats that could derail this supercycle.
Let's start with the most immediate one, margin compression. The CEO explicitly warned about this on the recent earnings call. He stated that memory costs, like the physical price of the storage inside these devices, are going to impact the business.
Yeah, they actually guided Q3 gross margins down to a range of 47.5% to 48.5%, which is a drop from what they just enjoyed in Q2. When raw materials get more expensive, the profit on every physical phone shrinks.
That is the reality of physical supply chains.
Ugh.
But we also have to factor in macro risks. That massive 28% revenue rebound in China we just praised, a significant portion of that was aided by Chinese government consumer electronic subsidies.
And those subsidies are scheduled to roll off in the second half of 2026.
Which means the upcoming quarter is going to be a brutal test of organic, natural demand versus subsidized demand in one of their most critical global markets.
Precisely. However, the mitigation strategy for the component costs is structurally built into the business model we discussed earlier. Yes, memory costs are rising and squeezing the hardware margins, but remember that high-margin services segment.
The one sitting at 76.5% margin.
Exactly. It is scaling much faster than the hardware side. The sheer volume of that digital revenue structurally offsets those physical component cost headwinds over time.
I get that. But what happens if the services segment itself comes under attack? Because that is the dark cloud hanging over this entire thesis. You have the DOJ antitrust lawsuit in the U.S. and the Digital Markets Act in the European Union.
Right. Both of these massive governmental forces are directly targeting the 30% App Store commission structure.
And that 30% cut is the golden goose of their services revenue. If regulators force them to let developers bypass the App Store entirely, a massive chunk of that 76% margin just evaporates.
The regulatory environment is undeniably hostile right now. And on top of the App Store issues, there is an FTC probe into ARM Holdings, which licenses the underlying architecture for the chips. So there is supply chain regulatory risk, too. But let's look at the actual measurable impact so far. Despite immense global friction and years of lawsuits, the anticipated regulatory damage has entirely failed to materialize in actual cash flows.
That's true. Services just hit an all-time record high.
Exactly. The moat, it turns out, is incredibly deep. Consumers simply prefer the convenience and security of the integrated ecosystem, even when they are given alternatives. And regarding the supply chain risks with ARM and TSMC, that brings us right back to why that rumored Intel Foundry deal is so vital. They are actively building a viable second source to mitigate those bottlenecks.
So with everything on the table, what's the final verdict? We have to weigh an unprecedented cash flow machine against very real regulatory crosshairs.
The final verdict, based on our 8 out of 10 bullish score, is that the supercycle growth thesis is fully intact. They are successfully executing a structural transition, effectively shedding the skin of a cyclical hardware vendor and emerging as a high-margin recurring utility.
Powered by an installed base of 2.5 billion active devices.
Exactly. The massive surge in R&D proves they are attacking the on-device AI market aggressively. And beneath it all, that $100 billion buyback provides a rock-solid floor, which supports a very clear long-term, multi-year investment view.
It is a remarkable pivot to witness. You have this device moat that is just unparalleled in the history of consumer technology. But I want to leave you with a final lingering thought, something for you to ponder on your own as we wrap up today's talk. Right now, we rely on search engines and massive cloud companies to answer our questions and process our data. But if this company successfully masters private on-device AI that can handle our daily tasks natively without ever pinging a server.
Do they eventually bypass the need for traditional search engines and cloud giants entirely?
Exactly. Could our personal devices become the ultimate self-contained walled gardens of the future? It's fascinating to think about. And if you want extra help reading trading charts, you can check out VIP indicators through the link below. The campaign is Grow 100 to $10 Ks with VIP indicators, and their tools include TradingView indicators, market alerts, and trading education with up to a 93% win rate. But trading always carries risk, and no profits are guaranteed. Use the tools for education and analysis, manage your risk carefully, and always do your own research before making any trade. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.